Hey everyone, in this video I'm going to analyze the stock of Pepsi. If you're new to the channel, my name is Dan. We do a lot of stock analysis on this channel. So if you're into that, hit the subscribe button to check out more videos. So here's the net revenue by region for Pepsi. So much like Coca-Cola, if you saw my earlier video on Coke, Pepsi is very diversified in terms of geographic region, giving it a lot of hedges against potential dollar devaluation or any other currency issues. Now, unlike Coke, Pepsi has quite a big portion coming from the US. So while they are pretty well diversified, multinational company, you still have a good chunk here from the United States. So here are some valuation measures for Pepsi. We have the price earnings ratio going forward, about 26. That's usually not a sign of a good deal. If a company has a PE ratio that high, but we're going to do more deep analysis and see if it is in fact a good deal. You can also see their price to book ratio is about 14. So you're paying about 14 times the book value to own shares of Pepsi. Turning to growth, Pepsi actually has pretty good growth for its industry, while numbers like, roughly 4% revenue growth going forward don't seem that exciting. It is beating the industry median there. One of the reasons a lot of investors are interested in investing in Pepsi is their streak of dividends. As you can see here, they not only maintained a streak of dividends for several decades, just about 48 years at the time I make this video, they've managed to increase it. So even though the dividend yield right now is a little bit below 3%, if you think about your yield on cost, eventually if they keep raising the dividends, your yield will be very attractive. So here is Pepsi's income statement for the past 4 years there, plus the most recent trailing 12 months. That would be 3 quarters in 2020 plus the last quarter of 2019. So what we see here is a pretty nice stream of revenue coming in, growing fairly steadily. And same with the net income, although it is a bit bumpier here. I do notice their operating income is a lot more steady than the net income, meaning there are some unusual items in some of these years that are dragging the net income down. So very similar to the Coca-Cola video, I'm going to do a vertical analysis where we take all the income statements and just divide each number by total revenues. So of course, revenue in every year is always 100% of revenue, but look at the other numbers here. It gives you a better sense of where this company's at. Gross profit averages just around 55% of sales revenue. That's pretty nice. So for every dollar of sales, you keep 55 cents after paying for the actual cost of the products. You have a good business there. What I don't like to see is that selling, general, and administrative expenses are taking up close to 40% of revenues. So you're losing quite a bit right there. Because of this, you're left with net income being equal to, on average, it seems about 10 or 11% of your revenues. So your profit margin is only about 10%. Now we can do a DuPont analysis and break down that profitability. That return on equity is actually very impressive there, close to 50% return on equity. But if you break it down, you can see the components. If you missed my video on DuPont analysis, do check that out. But ROE is essentially equal to the product of these three things here. Profit margins, 10.4%, not very impressive. It shows that there is significant competition in the industry. Asset turnover, 0.87. So for every dollar of assets in place, we're able to generate 87 cents of sales every year. Pretty good. But the product of these two, return on assets, is not very impressive. It's going to be less than 10%. What's driving up the ROE? It appears to be that equity multiplier, meaning Pepsi's profitability is driven really by debt. They're highly leveraged. You can see the leverage by looking at their balance sheet ratios. Liabilities to assets ratio is 85%, fairly high. Not super concerning for a company like Pepsi with a steady revenue stream, but not what you like to see there. Current ratio and quick ratio are both below 1. Company has negative working capital. Long story short here, their current liabilities are greater than their current assets. And this is not good. We like to see a company with a well-managed working capital, like to, not have excess cash lying around. That's great. But this is running it a little bit close here. I don't like to see that. So what I'm looking at here is the total payouts to shareholders. Now, companies can pay shareholders in the form of dividends, or they can buy shares back directly, reducing the number of shares outstanding, which increases the value of their investment. You're going to see stock price appreciation after buybacks. What we can see here is that Pepsi is a steady dividend payer, but I also noticed that their stock buybacks do account for a pretty significant portion of the money returned to shareholders. For this reason, I think we're going to use a free cash flow to equity model to value Pepsi rather than a dividend discount model, which I had used for Coke because they hardly were doing any buybacks at all during the past few years. All the money returned to shareholders was in the form of dividends for Coke. But for Pepsi, it looks like free cash flow to equity is going to work better. Okay, so with the free cash flow to equity model, it looks like this. And what we do here is we have a 5 normal abnormal growth period where we assume that free cash flow to equity is going to grow at some abnormal rate. After that time, we have what's called a terminal value of the company. And that terminal value is just going to be equal to what is the free cash flow of equity at that point in time. And we're going to divide that by the discount rate minus the perpetual growth rate, which is usually, 2, maybe 3%. It represents how much is this company's income going to grow in perpetuity, if we just assume accounting for population growth or inflation or whatnot. So to make the model work, I'm going to go to seekingalpha.com and get the analyst estimated growth rate for their income over the next 3 to 5 years, and that is 6.24%. That's the growth rate during the abnormal growth period. What I'm going to do to estimate free cash flow to equity is, because Pepsi's free cash flow to equity has actually been very volatile over the past few years, I'm going to take the past 3-year average, and then I'm going to grow it by 6.24%, and that's my estimate of the free cash flow to equity for the next year. And I will then increase that by 6.24% every year for the next 5 years, and those are my estimates for the numerators in the formula, free cash flow to equity. The discount rate is always a tricky one to estimate. Even though we have a very low risk-free rate right now, you can see the debt ratio on Pepsi is very high. That has some added risk. I'm going to use a slightly higher discount rate. So here what I have is a valuation matrix for the fair value of a share of Pepsi right now, depending on your estimate of how much free cash flow to equity will grow over the next 5 years, and also depending on the discount rate you use. Now, I think Pepsi is a rather risky investment with the debt ratios they have. I would lean toward an 8 or even a 9% discount rate. If you do that, even if you assume that Pepsi is able to grow their earnings at a rate of 7%, which is above even what analysts are estimating, it's still not going to be worth it given Pepsi's current share price. Now, only under the most optimistic scenarios is Pepsi a buy right now. If you use a 6% discount rate and you assume a 7% growth rate in earnings over the next 5 years, then Pepsi could be worth $172.05 per share. But that is not even a great deal when they're selling currently for $138. You have a little margin of safety, but it's not an absolute bargain by any sense. So if we look at the insider trading data, that looks pretty positive so far. During the past 3 months alone, you have 24 insiders making purchases and only 2 making sales. Now, on the downside, when you look at the number of shares involved, it's a lot closer here. 21,000 shares bought, 15,000 shares sold. Over the past 12 months, it's a little bit better. But in any case, it's a fairly immaterial amount of shares being exchanged here. So it doesn't look like that strong of a signal to me. Okay, so here are my final thoughts. My first final thought is you should hit that like button. That will help you in your investments. Secondly, seriously though, I don't think Pepsi is a good buy right now. Insider trading data is pretty neutral, but when you look at the numbers here, this is a highly leveraged company that has some liquidity problems right now when you look at their current ratio and their quick ratio. And it's just not worth it. It's not giving you the opportunity to earn a very good return on your money. Now, Pepsi has a very solid business, and they have a payout ratio this year of about 74%. So they can certainly afford to continue to pay that dividend and continue to raise that dividend. So a lot of dividend growth investors may be interested in the company, but I cannot recommend it. It is a low risk of going out of business, but a very high chance in my mind of getting a low return. Anyhow, those are my thoughts. I hope you liked the video. If you did, again, hit that thumbs up. It helps me a lot. Thank you.